Well, we have a few of you here, so only the tough survive, I guess. But I tell you, at the beginning of the semester, people would find reasons to drop out. Too much homework, don't like the book, don't like me, don't like the class, don't like their neighbor, don't like school, don't like to get up. Uh, and then once in a while, they have a serious reason, they've got a sick family, so forth. Once in a while. But most people that drop or don't come to class is just excuses, not reasons. So, but anyway, you are here. That's what matters. I wish 100% of people in accounting could make an A. That don't happen. So forth. So, it's not a class you take for an elective or a fly by night class or a easy A class. I'm sure you have some of those. Okay, we were in chapter 6 and we've got to finish it up pretty much. But in chapter 6, we have a buyer and we have a seller. We have journal entries for the buyer and journal entries for the seller. We have those discounts for buyer and seller. We have those returns for buyer and seller, and so forth. So if you know those entries, you've got the meat of the chapter. And we do have a new multiple step income statement. It has cost of goods sold on it, subtracted from sales, gives you gross profit. Then you subtract all the operating expenses, broken down many times into sales and administrative. And then you may have to add on other income and subtract other expenses. That's called a multiple step income statement. All right, there's a page in the book I told you to look at. Now, what we're going to look at real quick this morning is the appendix. And as I told you, we will not have a lot of the appendix on the test. If we have anything in the appendix on the test, I'll let you know what it would be. All right, record merchandise under the periodic system. All right, purchase of inventory are recorded in a purchase account, debit purchase, not merchandise inventory. All right, and you purchase is debit for the invoice amount, not net. Okay, purchase of inventory are not recorded in the merchandise account. To repeat, in addition, the sale of merchandise are not recorded in the inventory account. You don't make double entries. All right, purchase discounts are recorded in a purchase discount account. And then the amount of that is subtracted from purchases. Now, a separate purchase returns and allowance account is used. So what you do, the basic formula, if I could, it's going to let me write on it this morning. You take sales minus cost of goods sold. That gives you gross profit. Now that's your new income statement under either one of these methods. Minus operating expenses gives you net income. That's under either method. But now how you get cost of goods sold under either method is different. Okay? Cost of goods sold is simply in a ledger account under perpetual. Cost of, when I say goods sold, it's merchandise sold or goods sold. It's in the ledger account because you make two entries when you sell something. In a periodic account, though, you've got to find cost of goods sold by taking beginning inventory plus purchases, gives you merchandise available minus ending inventory, gives you cost of merchandise sold. But now what they're saying here is we've got to get net purchases. We will buy goods, purchases. Now we'll subtract discounts and we'll subtract returns and allowances. And that would give us net purchases. And we may even have to add freight in. plus freight in. Now that would give us net purchases, and that's what goes here. Okay, so that is the periodic method. Now, those who have been working with Cengage, does it have any periodic problem on there? Yeah, I didn't want a whole lot of periodic on there. So how far are you with Cengage, Ryan? 89%? How about you?
About 17. 100%.
100%? Anybody else 100%? Who's over 70%? Margot, are you over 70?
No, not yet.
Kelly? How much, Kelly? 100? Okay. All right, but trying to finish that up by 30. Try to finish Cengage by 30. Of course, you know, you don't have to until the test day. But to keep up to date, try to have it done by 30. Okay. All right. And they tell you here under periodic system, we talk about freight in. So purchases is a debit. Purchase discount will be a credit. So these are the minus, and plus I was telling you about to give you net purchases. These are called contra accounts. That's the one method we used to stick with until computers came about. Computers enable all companies of any reason or nature to use the perpetual system to keep up with inventory. And of course, that's probably a good D-based program that most of these companies use to keep up with inventory. Well, here's some transactions. All right, Alexandra, this is periodic. We debit purchase and credit accounts payable. What if it's perpetual? What would we debit here?
And you would purchase inventory.
No. If it were perpetual, what would I debit instead of purchase? I'm comparing the two. Anybody? What? Oh, no. It would always be accounts payable, Kelly, credit. What would debit? We would debit merchandise inventory. Under perpetual. Under periodic, we debit purchases. All right. Now, how about this one? We're going to send back $500. We debit accounts payable and we credit purchase returns and allowance. Anybody take a guess? What would I credit there if it was perpetual? Right. Merchandise inventory. All right. Paid for the purchase. Same entry. No, not the same entry. Not the same entry. With debit accounts payable, credit, cash only. This $590 purchase discount, this would have been recorded as $29,410 to merchandise inventory. We would have recorded that net. Here we record it gross. So we take a purchase discount. All right. With debit accounts receivable, credit, sales. What would have to happen if that were perpetual? We'd have to debit cost of goods sold and credit merchandise inventory. It would take two entries. Okay, here we debit purchases and debit freight in and credit accounts payable. Somebody tell me what we would do with freight in. On a perpetual, we would debit merchandise inventory. Okay. And how about receive payment? Same thing, debit cash, credit accounts receivable, and cash sales would have to debit cost of goods sold and credit. Morning. All right. So that is perpetual, periodic. I just wanted you to look at it, and hopefully you do have some journal entries. Ryan, do you know if those were journal entries on Cengage or not for periodic? I am not worried about the adjusting process under periodic. However, this was determining cost of goods sold. This is what I told you to take beginning inventory. Here was my little formula. Plus beginning inventory plus purchases gives you merchandise available for sale minus ending inventory gives you cost of merchandise sold. Now that's the same thing we're saying here. However, to get net purchases, we had to subtract returns and allowances and discounts and add freight in. All right, we got net purchases, we added freight in, we got total cost of merchandise purchase. It's not a bad method, okay? But I like perpetual better. Look at the closing entries for a moment. You debit merchandise inventory and you debit estimated returns, you debit sales. All these accounts you have to close out. Purchase returns, allowance, discounts, and rent revenue. Then you close out all your expenses, including your beginning inventory. You got to get rid of your beginning and establish your ending. And then you close out purchase and freight in just like expenses. So that's pretty much the PowerPoint. Now we're going to look at a couple of problems this morning. I don't know if I assigned one of these or not. Did I give you a problem in chapter 6 on purchasing and selling perpetual? Which one was that, Ryan?
5A.
All right, 5A has everything in it, I think. Oh, 5A, you should have done income statement, of course, yeah. But did I not give you 4A? I think you ought to practice 4A, folks, for the test. But now, I have written down here that I gave you 3A. Did I give you 3A, Alexandra?
That's what I heard.
3A. All right. I gave you 3A. We'll go over that this morning and we'll go over 5A. And we're going to look at one on periodic and we're going to leave this chapter. But please dig in on this chapter. Do Cengage. It's a whole lot of information in one chapter. Let me find these solutions real quick. I don't see Johnny this morning. Johnny's usually here. Some of these folks that have dropped by the wayside, they didn't get their book until a month in. They got behind, I guess, and gave up. Well, let's look at problem 3A. This is one you're supposed to do. So I'll probably pass these around. Alexandra, starting with you. Problem 3A, page $332. Purchase merchandise on account from Moonlight Company. List price was $85. Trade discount $25. Terms FOB destination $210. Net $30.
Debited merchandise inventory for $62,475, and then credited accounts payable Moonlight for $62,475.
All right. Now, where do you get all these figures at? You have to take out the percent discount. You had to take out 25%. That's not recorded anywhere. Then what was left, he took off 2%, and that gave you net $62,475. Debit merchandise inventory and credit accounts payable. Like I say, if you didn't do this problem, do the next problem. They're almost identical. But you'll have all these entries on your next test. Okay, Seth, how about the next one?
So would debit merchandise inventory and credit sales.
Sold merchandise for cash, and it costs. You only got one entry there or two?
Those are got one as well. You debit cost of merchandise sold and credit merchandise inventory.
All right, under perpetual system, a sale requires two entries. Okay, let's sign that page. Okay, I will purchase merchandise on account from the Poos Creek Company, 47,500, terms FOB shipping point, 210, net 30, with prepaid freight of 810 added to the invoice. So, you got that one? No. Ryan, do you have that one? That entry? Yeah.
You'll debit accounts receivable.
Number 5. Ryan, you're way off. Okay. Let's see if y'all signed in. Tanner, have you got that entry?
I want to say it's a debit merchandise inventory and credit accounts payable.
Yeah, you know for how much? Okay. Marco, will you sign this? Okay. Yeah, you do debit merchandise inventory and your credit accounts payable. All right, you take out the discount and you add back the freight. Or you can make a separate entry for the freight, whichever. They just added the freight because we debit merchandise inventory for freight anyway. Had you wanted to debit freight had you wanted to debit merchandise inventory 810 and credit accounts payable for 810, you could have. You could have made two separate entries. But here we just made one entry with debit merchandise inventory and credit accounts payable. We are paying the freight because it was shipping point. Okay, Dylan, do you have that next one?
Debit accounts payable and you credit merchandise inventory.
All right. Number 6. Do you figure out the amount, Dylan? Okay, you're returning 13,500, but you recorded that net wherever we bought it. It was Moonlight Company, and we gotta return that net. We had to take out the 2% of the 13.5. So we got rid of some accounts payable, and we got rid of, merchandise inventory, 13,230. That's the side of the sheet.
Right here.
Okay, Margot, do you have the next one?
Yeah, number 6.
On the 13th, I think, no,
Okay.
number 8.
Number 8. Debit account receivable, credit sales for 15,600.
All right, that'd be one entry. You got another one?
Yes. Cost of merchandise sold, debited and then credit merchandise inventory for 9,400.
Remember on the test, I always asked you on a perpetual system, do you have another entry for savings? And you do. All right, Kelly, how about the next one?
Debit account payable and credit cash, 45,200.
All right, we're just paying accounts payable. Debit accounts payable and credit cash, 49,245. Okay. Robert, were you the one doing some kind of business on the internet?
Mm-hmm.
You still do that?
Yes, sir.
Now, you keep up with your sales and your purchases and,
Yeah.
all right. Now you do this yourself or you have somebody do your accounting for you?
Well, I do it myself, but I mean, I don't know. Yeah, I do it myself. I don't have nobody else to do it for me. But I do keep a log of my sales. Like I do a monthly myself for the month and like my purchases and stuff.
So you probably don't have very many expenses, do you? Since,
No, I mean the only expense I have is me just making the stuff, my actual making my product. I make clothes.
wait a minute, expenses are do you make them?
Mm-hmm.
Okay. Well, you have the expenses of all, okay, you don't buy them and just resell them.
No,
You buy the materials and make them and resell them.
Mm-hmm.
Okay. Well, you still got cost of merchandise sold in there. All of your materials and, I don't know, overhead. If you would turn that into taxes, there's a lot of tax breaks you could get. But, okay, moving on. We sold merchandise on Visa for 236. So I'm just going to move on with that one. On the 14th, selling merchandise on Visa is the same as cash, isn't it? Visa, MasterCard. I think this book's counting American Express, Discover, and everything just as cash. And on the 15th, we paid this company on account for purchases of November the 5th. Now, if we go up there on November the 5th, how much did we buy? 47 what? 360? All right, but how did we send any back? That's not the one we sent back, is it? All right, so we should pay 47,360. Yeah, just the whole amount, 47,360. Debit your accounts payable and credit your cash. Recorded cash on account from sale of November. Received cash on account. Okay, Jacob, how about that one?
Receive cash on account.
Yeah.
You would, debit cash for 15,600 and then credit accounts receivable for 15,600.
All right. Debit cash, credit accounts receivable. That was for merchandise we sold Quinn Company up there on the 8th. Sold merchandise on account. This is the same old entry. We sold merchandise on account. Takes two entries. Debit accounts receivable, credit sales, debit cost of merchandise sold, and credit merchandise inventory. All right, we paid Visa services for $35.40. Alexander Fanning, how about that one?
I could be wrong on the account, but I want to say it's you debit credit card expenses.
Right.
35.40 and then credit cash. For
That's all you do. You paid your credit card expenses. All right, we paid Oquin a cash refund of $6,000 for return merchandise from sale of November. The cost of the return merchandise was $3,300. Let's just look at that one. All right, here's merchandise return. All right, that merchandise cost us $3,300. Debit merchandise inventory. All right. Now, under the other method, it would have been sales returns and allowance under periodic. But here we put estimated returns inventory, same as returns and allowance. But now the refund we owe the customer is $6,000, and we'll credit cash. Customer refund and credit cash. All right. This customer had already paid us in full. If he hadn't paid us in full, would have had to use accounts receivable here, I guess. All right, instead of cash. Okay, folks, so as a bonus for the test, please have 4A ready to hand in. As a bonus for the test, have 4A ready to turn in on test day. All right.
That's gonna be the 5 point along with the,
Well, I didn't say 5 points. If you have Cengage finished, that's 5 points. All right, but 5A is your new income statement. And if you notice, you take sales minus cost of goods sold, gives you gross profit, minus selling expenses. All right, which include sales, salaries, advertising, store equipment, depreciation, and miscellaneous. Then you got administrative expense. And you got income from operations, $964,400. You may have other income and other expenses. Interest expense of 21 leaves your net income of 943. Okay. So these will not let me write on them. Now, this is no different than what I've been showing you in short form. In short form, that is your sales minus cost of merchandise sold gives you gross profit minus operating expenses, which is selling expense and administrative expense. That gives you net income from operations. That's all that income statement is right there. And then we may have to subtract interest expense, and that gives you final net income. It's not a hard statement. Ryan, do you learn things from abbreviations?
sometimes.
Sometimes.
I abbreviate most of my things, like missed selling or depreciating XP, SE.
Of course, in accounting, we should not abbreviate. I abbreviate a lot in teaching, Okay, so that is exercise or problem 6, okay? Now, we're gonna look at your appendix. I don't know how much of this I'll have on the test. I'll let you know if I do. If I had this on a test, I would give you a one-liner for selling expenses. And I would give you a one-liner for administrative expenses. And cut it down a lot, wouldn't it? You would not have to write all these expenses. Okay? And remember, you add interest, subtract interest expense. But if I had other income, like interest income, I'd add it, wouldn't I? Okay? All right, so that brings us up to date with perpetual. Please finish your Cengage. All right. I'd like to have done some posting from that chapter, but we just don't have time to do the posting. Now, I want you to look at the appendix for a minute, and there's a page of journal entries in that appendix. That would be page 311. Is the journal entries, which I showed you a moment ago. I showed you a moment ago on PowerPoint. Couldn't think of what I showed you. All right. Now, they used to have a good comparison, but this book does not have a good comparison. But I asked you those periodic entries as we went along. All right. Of course, they always have a good illustration problem you should look at. All right, let's go to page 329. All right. Here's an income statement, but not statement of owner's equity doesn't change, balance sheet doesn't change. That was all in that one problem. And I don't know why these solutions are overlapped, but they are. But what I want you to try real quick, take a couple of minutes and see if you can do exercise 37. I've been showing you that a couple of different times. See if you can do exercise 37. Work together, whatever you need to do. That's illustrated on page 312. Page 312. Exercise 37.
I missed that, I missed this whole chapter.
One of your classmates was watching live stream this morning, and the text they sent me, I'll be EATING, the live video. I'll be eating the live video. They must have been eating when they text this
Yeah.
or something.
Gotta love, autofill.
Do what?
You know, if you send a text enough, it will automatically assume what you're supposed to be saying.
Well, they can do that too, I know. Or you can start a word and it'll give you the wrong word, or if it tries to correct your spelling.
I missed it. I think. This section, that's gonna be like going to this. Comes with math, so there is like a small. It's like a quarter piece, or don't have a quarter. Who did? finances, then I'll go to
Exercise 637. Let's see. Hope I have something on that. I've got the problems, but I don't know about the exercise. Let me back up at the end of the others. Should be here. Okay, did anybody come up with a format something like you see? Merchandise inventory beginning plus purchases. Now to get purchases, subtract returns, discounts, and freight. You get merchandise available for sale minus ending inventory gives you cost of merchandise sold. But you have an increase. Usually it ends right here. But now this book, this edition has added estimated returns inventory to subtract. Did anybody get 440? Guys, anybody here? Margot did, Kelly did, Joshua did. Alexandra?
I'm still working on it.
All right. If you got that, great. If you didn't, do 38. Not now, but do 38 later. Now, as far as this chapter goes, the only other thing I'm going to assign you from the appendix is trying to find it. Probably do exercise 34. So for Thursday, if you could have exercise 34 and 38 done, we'll go over those and we'll therefore end periodic. All right, now we're going to get into chapter 7. We'll back up later on those. But now in chapter 7, it's inventory and its methods of inventory. These two chapters go together well. They go well together for test purposes also. Now on inventory, we're going to be looking at some inventory methods. FIFO, LIFO, FIFO, and there is a gross profit method and a retail method. There's a lower of cost to market method, but these are the two main methods. Now the thing about these, we can do LIFO and FIFO, perpetual or periodic. So there's a lot of methods to learn in this chapter. I'm going to try to give you a little bit of PowerPoint to start this chapter today. This chapter we'll need to practice and practice. We know what a physical inventory is. There was a mining supply company in my area. Merchandise would come into the warehouse and it was stored. Delivery man would pick up an order, take to a mine. But what happened, the warehouse man would load double orders. The delivery man knew there was double orders. Delivery man would drop off the correct order at a mine, and then it drop off a duplicate order at some shack or whatever that they had hid out somewhere. Then they'd load all those mine supplies and take them to Ohio, sell to the mining companies up there, and 1/3 of what they didn't pay somebody else. So, and I think the bookkeeper might have been in on it, the accountant. Bookkeeper, the warehouse man, the delivery man, but they were all caught. They were all fired. But I think the company was just glad to get rid of them and they didn't prosecute, but they could have. So it was embezzlement. That's what you really call employee pilfering, isn't it? Okay. All right, but we still need a physical inventory, periodic or perpetual. Now, we count inventory. Okay. Here, we have 3 units of inventory. And what FIFO and LIFO is about, we go back and take inventory, and we've only got 1. What price do we put on that 1 unit? Do we put $9 on it? Or do we put $14 on it? Or do we take an average of $12? Average is another method, okay? We're going to sell 1 unit. And what unit did we sell? We sold it on May the 30th. All right. Was this when we bought them? Well, that was sales up to that point. Cost of merchandise sold, gross profit, ending inventory. So depending on what method we use, your ending inventory could have a different price. Now, the Pacific identification method, that's used for things like medicine or automobiles, a used car lot, a new car lot, and even jewelry stores. You can't have 10 diamond rings and say the last one in or the first one out. There's so different prices on those diamond rings. So Pacific. Medicines would be good for Pacific, automobiles, and jewelry stores. Pacific. That's just when you go around and get the price off of the item, what it cost. All right. First in, first out assumes that we sell the first units we bought. Last in, first out assumes we sold the last units we bought. And weighted average is just an average. Now, right there are 6 methods, folks. 3 perpetual and 3 periodic. 6 methods. Assume that 1 unit is sold on February the 27th for $70. And February the 27th is probably right in between here, isn't it? All right, February the 27th. Determine the gross profit for February and ending inventory using the first in, first out. All right. What unit did we sell if we're using first in, first out? Wait a minute, we sold one here on the 27th, didn't we? We'd already bought 3 units. Now, which one did we sell for how much? That's right. We sold the first one in. Okay. Now, which unit did we sell, assuming LIFO? Okay, Ryan's already got that in hand, okay?
What about the 27th? Wouldn't that be the last one we sold?
Do what now?
We said we sold one on the 27th for $70.
All right, we're going to sell it at 70, no matter what method we use.
Oh, okay.
But how much profit do we have on that 70 is a different story. Under FIFO, we subtract $45. How much profit would we have? 70 minus how much? All right. Now, but if we use last in and we subtract 51 from 70, what's our profit? It makes a difference what our profit is. It makes a difference what our inventory is, don't it?
So we always go with FIFO and then we make more profit.
Well, companies go with both methods. FIFO is more popular because we usually have rising prices. Now, if you go with last in, first out, you may have some old inventory on there. If you were doing annual inventory, it may have cost $10, and now that inventory is up to $50 a unit. So it depends if there's inflation or deflation, but the majority of companies would use FIFO. Sell the oldest ones first. All right. Now look at this. How many units do we have? All right. How many did we sell? How many does that leave us? That leaves us 300 units at $20. All right, now we're going to purchase. Now we've got 500 units at what? All right, now we're going to sell. What 360 are we going to sell? What 360 are we going to sell? Under FIFO. We're going to sell those 3, aren't we? And we're going to sell 30 of these 500 or 60. And that leaves us 440 at 2240. All right. Now we're going to sell 240 more. Where do they come from? Out of these 440, right? That leaves us 220 or 200 at 2240. And then we bought some more at 2330. So that's what you got to keep up with, perpetual FIFO. And an inventory of what? I don't know. Let's multiply 600 times 2330 and 200 times 2240. Work that out, Ryan, and add it together. How much? If Ryan multiplied right, that's what you'd have. All right, let's look at it on a chart. Now, you'll have these charts on Cengage, but I'll have to bring them to class with me when we practice one in class. All right, but here's the ending inventory that Ryan gave you, 18,460. Did you say 60? Okay. All right, but here we're keeping up with it on a sheet, an inventory sheet, which makes it easier. easier than what I did just a moment ago. Here we have $1,000, $20,000. All right. We sold 700. That left us 300. And you follow this thing through just like I did a minute ago. So you have your ending inventory, and you also have your cost of merchandise sold. Your cost of merchandise sold and your ending inventory. Now that's FIFO. Now, if this were LIFO, we'd still had to sell these 700 units, wouldn't we? And then we bought how many? And then we sold how many? Did we sell 360? Now, if this were LIFO, what 360 would I sell? No, that's FIFO. Right. Now, the last 500 we bought, we'd sell 360, and the cost would be $22.40. That's LIFO. It's got a handle on FIFO, but probably to show you. Show you the same problem. Now you can see how your inventory and cost of goods sold differ under two methods. It might be what you want to do for tax purposes that decides what method you want to use, okay? But anyway, total cost $17,980 under this method. Now here we sold these 360 at $22.40 out of the last units. That left us 320. That left us 140 at $22.40. And then we sell 2 more hundred. That's LIFO. Let's see now. On the 28th, we sold 240. So what did we sell? Let's see, 140 that was left out of 500, and then 100 at $20. That left us $220. See, we're keeping that old inventory around, 200 at $20. And what do we have left? Now we have 600 at $23.30 and 200 at $20. Which will be the next one we'd sell? We'd sell the 200. No, if it were LIFO, we'd sell out the 600, wouldn't we? We may have that 200 on there forever. What have you? All right, so read this chapter well. So we got a lot to cover on Thursday. Finish up your audit, chapter 6, and really get down to the nitty-gritty of these methods. All right, now the weighted average is a little tougher. That's why I'll have to bring you those sheets. The weighted average, you add your inventory together. Here we sell 700, that leaves 3. Now, we bought 500. 3 and 5 gives us how much? 3 plus 5 is 8, right? We got to add the cost also. We got to take this 6,000 and add it on to this 11,200. So that will give us 17,200. Divided by 800 units gives us the 2150. You got to take the average every time, excuse me, you have a purchase. Not when you have a sale. Take the average every time you have a purchase. So we got the average inventory cost here of $22.85. So that's 3 methods, perpetual. FIFO, LIFO, average.
The average on that, are they taking into account how much was that $20 and how much was that $22.40? Or are they just saying it's all somewhere in the middle?
No, well, yeah, it's somewhere in the middle, right? It's not going to be $20, and it's not going to be $22.40. It's going to be somewhere in the middle. An average is in the middle. It's actually in the middle of LIFO and FIFO also. Now here we're going to look at periodic. Here, how many units do you have available for sale? And we're going to look at periodic. That's cost of merchandise available for sale. Now, real quickly, under FIFO, let's stay here a minute. Let's assume you have let's assume you have 700 units in ending inventory. Now, under FIFO, what 700 do I have? You don't have to look at dates now. For periodic, just look at what you've got. You don't have to look at dates. I've got 700 units left. What 700 do I have left under FIFO? Remember, FIFO means first in, first out. I sold these 1,000, and I sold 400 of these. So what 700 do I have left? I have 100 at $22.40 and 600 at $23.30. If this were LIFO, what 700 would I have left? Hey, you're catching on, Ryan. And that would be 1,400, 14,000. Okay. All right. So it works the same LIFO and FIFO does, but you don't have to take it after every sale and every purchase like you do perpetual. And the average is real easy. All right. If I'm going to average here, if I've got 700 units left, now my total purchases is 45,180, right? Divide that by the total units I have available. All right, give me the average cost. Somebody divide 21 into 45,180. A couple of you actually use your calculators. All right, what's my average price? 21 what? Anybody else get 21.51? Is it somewhere in between the high and the low here, isn't it? It's more than 20 and less than 23. It's got to be somewhere in the middle. And you simply multiply that by 700 units to get your ending inventory. So that's 6 methods we've already looked at. We will have to practice them, okay? They're going through these in a different way. We'll look at those later. But now if we compared these methods, the ones we did glance at, you can see the gross profit is going to be different. Now average is somewhere in the middle. It's in the middle of 11.8 and 12,280. Your merchandise inventory is somewhere in the middle. Okay. The weighted average. Okay, I have thrown enough at you today, and I'm going to let you go.
I actually approved you.